There is a moment in every great investor's life, a single transaction, a single decision that acts as a philosophical fulcrum, tilting their entire worldview from one axis to another. Before this moment, they are one kind of thinker, operating under a set of rules that have brought them success, that have proven their worth. But after this moment, they are reborn, armed with a new and vastly more powerful lens through which to see the world of money, business, and value. For Warren Buffett, the man who stands as the modern icon of investing, this moment didn't happen in a frenzy on the floor of the New York Stock Exchange. It didn't happen while poring over arcane financial statements in a dimly lit office. It happened, of all places, over a box of candy. The year was 1972, and Buffett, then in his early 40s, was already a legend in the making. He was the master of a very specific craft, a discipline he had learned at the feet of his intellectual father, the great Benjamin Graham. The craft was called value investing, but in its purest form it was something Buffett would later affectionately call cigar butt investing. The idea was simple, elegant, and brutally effective. You walk down the street, and you find a cigar butt on the ground. It's soggy, it's discarded, and it's ugly. But it has one good puff left in it. You pick it up, take that final, free puff, and you throw it away. You don't fall in love with the cigar butt. You don't plan your future around it. You simply extract that last bit of overlooked value and move on. In investment terms, this meant finding companies that were trading for ridiculously cheap prices, often less than the cash they had in the bank or the value of their inventory. These were not great companies. They were often mediocre, sometimes even terrible businesses in dying industries. But they were statistically cheap. They were the market's cigar butts. And Buffett became a master at finding them, taking his free puff and compounding his partners' money at a staggering rate. His entire mental framework was built on this foundation. Price is what you pay, value is what you get. And the goal was to get far, far more value than the price you paid. This meant the price had to be, above all else, dirt cheap. Then, a man named Charlie Munger entered his life, not just as a business partner, but as an intellectual catalyst. And Munger brought with him a profoundly different philosophy, a philosophy that would lead them to that fateful box of candy. The company was See's Candies, a beloved West Coast confectioner with a fanatically loyal customer base. The See family wanted to sell, and a deal was brought to Buffett and Munger. The business was, by any measure, a wonderful business. It required very little new capital to grow. It had immense brand loyalty that gave it pricing power. It could raise its prices year after year without losing customers, and it gushed cash. It was the polar opposite of a struggling, capital-intensive cigar butt like the Berkshire Hathaway textile mill Buffett had bought years earlier. Here was the problem. The See family wanted around $30 million for the company. Buffett, the Graham disciple, ran the numbers. He looked at the book value, the tangible assets, the stores, the equipment, the inventory. He calculated the earnings. And his cigar butt brain came to a firm conclusion. The business was only worth about $25 million. He was not going to overpay. He was ready to walk away from the deal over that $5 million difference. The old Buffett, the pure Grahamite, would have walked away without a second thought. A cigar butt is only a bargain at a cigar butt price. This was a fine cigar, and it was being priced like one. He was about to let one of the greatest investment opportunities of his life slip through his fingers, because he was anchored to a framework that was built for a different kind of game. It was in that moment of hesitation that Charlie Munger delivered the intellectual nudge that would change the course of financial history. He looked at Buffett and essentially said, "Are you really going to let a business this good go for a few $1 million? You're thinking about this all wrong. We are not just buying the assets on the balance sheet, we are buying a brand, we are buying a moat, we are buying decades of future cash flow that barely exist in your book value calculation." Munger was forcing Buffett to lift his eyes from the spreadsheet and see the reality of the business. The true value of See's Candies wasn't in its candy-making machines. It was in the mind of every customer who thought of See's when they needed a box of chocolates for Valentine's Day or a birthday. That intangible asset, That brand loyalty was a far greater source of value than any tangible asset on the books. Buffett, to his immense credit, listened. He fought his instincts. He overrode decades of conditioning. He and Munger made the deal, acquiring See's Candies for $25 million in 1972. It was a fair price. It was not, by his old standards, a wonderful price. But it was for a truly wonderful business. And what happened next became the foundational proof for his new philosophy. That $25 million investment, that fairly priced candy company, would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway in the subsequent decades. The cash it produced, year after year with minimal capital investment, became a torrent that Buffett could then use to buy other wonderful businesses. See's Candies became Berkshire's financial engine, the gift that never stopped giving. It taught Buffett the most important lesson of his career, a lesson that would form the core of his final promise to investors. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This single experience, this epiphany over chocolate, was the demolition of his old mental model and the construction of a new one. He realized that the game wasn't about finding that one last puff in a discarded cigar butt. The true game, the game of immense and generational wealth creation, was about owning the entire cigar factory. And for a factory that will produce cigars for 100 years, you can afford to pay a fair price. He had to unlearn the very habit that had made him rich in order to become truly wealthy. He had to transition from a bargain hunter to a business owner. This pivot, this painful but ultimately liberating intellectual evolution, is the secret that separates the merely good investor from the truly legendary one. It's the understanding that for the best companies in the world, the perfect price, the cigar butt price, almost never comes. Waiting for it is not a strategy of discipline, it is a strategy of absence. It is the act of standing on the platform, waiting for the perfect train, while the express to the future of compounding thunders past you, leaving you in its wake with nothing but the cold comfort of your uninvested cash. The See's Candies deal was more than a transaction. It was a testament to the power of intellectual humility and the astronomical opportunity cost of a rigid mind. The human mind is a marvel of efficiency, a biological machine honed by millennia of evolution to make quick judgments based on incomplete information. To do this, it relies on a set of mental shortcuts, heuristics, and biases. These ingrained pathways are incredibly useful for navigating the everyday world. They stop us from re-evaluating whether a hot stove is dangerous every time we enter a kitchen. But in the world of investing, a world of probabilities, abstract value, and emotional extremes, these same mental shortcuts often lead us directly into catastrophic error. The deep-seated, almost primal human desire to hunt for a bargain is one of the most powerful and dangerous of these biases. And understanding why we are so psychologically wired to seek a wonderful price is the key to unlocking the freedom to pay a fair price for a wonderful business. At the heart of this phenomenon lies a cognitive bias known as anchoring. When we are trying to determine the value of something, our brain latches onto the first piece of information it receives and uses it as a reference point, or an anchor, for all subsequent judgments. Consider a stock trading at $200 per share. 6 months later, after a market correction, it's trading at $140. The retail investor, looking at this, anchors to the $200 price. Their brain screams, "It's on sale! It's 30% off!" They feel like they're getting a deal. Conversely, imagine a world-class company, a titan of industry, whose stock has steadily climbed from $100 to $200 over the past year. The investor who has been watching it anchors to that $100 price they remember. Now, at $200, their brain tells them, "You missed it. It's too expensive. I'll wait for it to come back down." In both cases, the actual intrinsic value of the business, its earning power, its competitive advantages, its future growth, is completely ignored. The decision is being driven not by a rational assessment of value, but by an arbitrary anchor point from the past. Warren Buffett's evolution required him to consciously sever this anchor. He had to stop asking, "Is this stock cheaper than it was last year?" and start asking, is the price I'm paying today substantially below the value this business will likely generate over the next 10 years? This is a profoundly different question, one that requires forward-looking analysis rather than backward-looking price comparison. It replaces the cheap thrill of bargain hunting with the sober satisfaction of value capturing. Tangled with the anchoring bias is an even more potent psychological force: loss aversion. Pioneering work by psychologists Daniel Kahneman and Amos Tversky revealed a startling asymmetry in the human psyche. The pain of a loss is felt roughly twice as intensely as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This neurological reality has devastating consequences for investors. The fear of buying a stock at a fair price of $100 and seeing it temporarily dip to $90 is overwhelming. That $10 paper loss triggers the full, painful force of loss aversion. To avoid this potential pain, investors demand an enormous discount. They tell themselves, "I'll only buy it if it drops to $70. They are not setting a price based on value. They are setting a price that creates a psychological cushion against the pain of a potential short-term dip. They are trying to build a fortress against feeling bad. But in doing so, they often build a fortress that keeps the great opportunities out. The stock may never see $70 again. It may dip to $90, then rally to $200, then $500. The investor who is trying to avoid the pain of a small, temporary loss ends up suffering the much greater, albeit less immediate, pain of a massive missed opportunity. Buffett's genius is his ability to invert this. He has trained himself to see a decline in the price of a company he loves, not as a loss to be feared, but as an opportunity to be embraced. When the price of Coca-Cola or American Express fell after he had purchased them, he didn't panic. He often bought more. He had done the work on the business value, and he understood that the market's short-term price fluctuations were emotional noise, not a fundamental reassessment of the company's long-term worth. He operates with a time horizon so long that the short-term squiggles of a stock chart become utterly irrelevant. Finally, there is the simple biochemical reality of the deal-seeking brain. Finding a bargain, whether it's a discounted sweater or a stock trading below its book value, triggers a small release of dopamine in the brain. It's a pleasure response. We feel smart, we feel like we've outwitted the system. The cigar butt style of investing that Buffett practiced in his early days is perfectly engineered to provide these regular dopamine hits. You find a statistically cheap stock, you buy it, it pops 20 or 30% as the market recognizes the discrepancy, you sell, and you get that rush of being proven right. It's an addictive loop. The Munger-inspired philosophy of buying wonderful businesses at fair prices is far less satisfying on a short-term neurochemical level. You buy a great company, and it might do nothing for a year. It might even go down. There's no quick pop, no immediate validation. The reward is deferred, sometimes for years. The payoff is not a quick trading profit, but the slow, patient, and ultimately immense power of compounding. This requires a completely different psychological constitution. It demands a shift from the mindset of a trader seeking quick hits of validation to the mindset of an owner seeking long-term partnership in a great enterprise. It's a form of delayed gratification that is deeply unnatural for the human brain, which evolved to prioritize immediate rewards and threats. So when the average person looks at the stock market, they are not seeing a collection of businesses. They are seeing a minefield of potential psychological pain and a playground of potential dopamine hits. Their decisions are governed by arbitrary anchors, a crippling fear of short-term loss, and a craving for the thrill of the hunt. To transcend this, to reach the level of thinking that Buffett and Munger occupy, one must engage in a conscious act of psychological warfare against one's own instincts. It requires a deliberate system to override these deeply ingrained biases. It means building a framework of analysis that is so robust, so logical, and so focused on long-term business reality that it can act as a bulwark against the emotional tides of the market and the treacherous shortcuts of one's own mind. The final promise is not just about a financial strategy. It is about achieving a state of psychological liberation from the very instincts that make most people fail. To truly grasp the monumental shift in Buffett's thinking, one must understand the raw, mathematical power that drove it. The principle of paying a fair price for a wonderful business is not a folksy aphorism. It is a conclusion rooted in the inescapable logic of compound interest. It's a recognition that over a long enough time horizon, the quality of the business you own is a far more powerful determinant of your returns than the cheapness of the price you paid. The engine that drives this phenomenon is a concept known as return on invested capital, or ROIC. In simple terms, ROIC measures how effectively a company uses its money to make more money. Imagine a business has $10 million of capital invested in its operations, factories, technology, inventory. If it generates $1 million in profit from that capital in a year, its ROIC is 10%. A business that can consistently generate a high ROIC, say 20 or 30%, is a financial masterpiece. It is a machine that takes in $1 and turns it into $1.20 year after year. A fair business, the kind Buffett used to buy as a cigar butt, might have a much lower ROIC, perhaps 6 or 8%, just barely above its cost of capital. It's not a bad business, but it's not a compounding machine. It's more like a savings account than a rocket ship. The magic happens when a high ROIC business retains a portion of its earnings and reinvests them back into its own high-return operations. Each dollar of retained profit is not just a dollar, it's a new soldier sent into battle to earn that same high rate of return. This creates a feedback loop, an exponential growth curve where value builds upon value at an accelerating rate. This internal compounding is the secret sauce. It's the force that makes a slightly higher initial purchase price shrink into insignificance over time. To make this tangible, let's construct a blueprint, a mental model that translates this theory into a practical decision-making framework. Let's call it the compounding X-ray. Step 1 of the compounding X-ray is to completely ignore the stock price and the PE ratio. These numbers are the market's opinion, not the business's reality. Instead, you must first diagnose the health and power of the business's internal compounding engine. Ask 3 questions. First, does this business have a history of earning high returns on invested capital? Look back 10 years. Has the ROIC been consistently above, say, 15%? Second, does the business have the opportunity to reinvest its earnings back into its operations at similarly high rates of return? A company might have a great core business but no room to grow. A truly wonderful company has a long runway of profitable reinvestment opportunities. Third, is the management team skilled and shareholder-friendly in its capital allocation? Do they wisely reinvest for growth, or do they squander cash on foolish acquisitions and overpriced share buybacks? This initial diagnosis separates the wonderful businesses from the merely fair ones. Only a company that passes this 3-part test is even a candidate for purchase. Step 2 of the X-ray is to run a simple, forward-looking thought experiment. Let's compare 2 hypothetical investments. Company A is a fair business. It's a solid, if unspectacular, manufacturing company. It earns $1 per share. Because it's a competitive industry with no real moat, you are able to buy it at a wonderful price of 8 times earnings, or $8 per share. Its ROIC is a mediocre 7%, and it can only grow its earnings at a rate of 3% per year. Company B is a wonderful business. It owns a dominant software platform with immense switching costs. It also earns $1 per share, but because the market recognizes its quality, you have to pay a fair price of 20 times earnings, or $20 per share. Its powerful moat allows it to generate a high ROIC, and it can sustainably grow its earnings at 15% per year. The bargain hunter, the old Buffett, would buy Company A every single time, $20 for $1 of earnings? Outrageous! $8? Now that's a deal. But let's apply the compounding X-ray and look forward 10 years. For Company A, the earnings per share, growing at 3% per year from a base of $1, will be approximately $1.34 in year 10. If the P/E ratio remains at a, quote, cheap 8 times earnings, the stock will be worth $10.72. Your initial $8 investment has grown, but it's hardly life-changing. Now look at Company B. Its earnings, growing at 15% per year, will have compounded to $4.05 per share in year 10. If its P/E ratio stays at a fair 20 times earnings, the stock will be worth $81. Your initial $20 investment has more than quadrupled. Even if the market sours on it and the P/E ratio contracts to a more modest 15, the stock is still worth over $60, a triple on your investment. The massive difference in the quality of the business, its ability to compound capital internally, has completely overwhelmed the initial difference in valuation. The extra $12 per share you paid for quality at the beginning looks like a pittance compared to the $70 extra in value the business created for you over the decade. This is the mathematical core of the final promise. The growth in the intrinsic value of the business itself creates the lion's share of your long-term return. Getting the business right is vastly more important than getting the initial price perfect. This mental model liberates an investor from the tyranny of the P/E ratio and refocuses them on what truly matters, the quality and durability of the business's compounding engine. It transforms the act of investing from a static analysis of today's price to a dynamic analysis of a business's future value creation potential. The path of the 99% is the exact opposite. The average retail investor is obsessed with price. They hunt for low P/E stocks, stocks hitting 52-week lows, stocks that have been beaten down. They are running the playbook for Company A. They might find a few that bounce, giving them that quick dopamine hit of a successful trade. But they are running on a treadmill. They buy a mediocre business, it appreciates a little, and then they have to sell it and find the next mediocre idea. They never get to experience the effortless tailwind of a truly great business, compounding away on their behalf. They mistake activity for achievement. The person who buys Company B, the wonderful business, can do the most powerful thing in all of investing: nothing. They can sit back and let the brilliant management team and the powerful competitive moat do all the work. Their wealth isn't built on their ability to trade in and out of stocks. It's built on their initial wisdom to partner with an exceptional enterprise. The financial connection is stark and undeniable. A portfolio filled with cigar butts might generate decent, if inconsistent, returns. It is a portfolio that requires constant work, constant vigilance, and constant turnover, with all the associated taxes and transaction costs. A portfolio of carefully selected, fairly priced, wonderful businesses becomes a collection of compounding machines that build wealth automatically, quietly, and exponentially. It is the difference between being a pawnshop owner, constantly haggling over the price of used goods, and being a shareholder in the world's most profitable and durable enterprises. It is the difference between working for your money and having your money work with breathtaking power for you. If an investor is to embrace the philosophy of paying a fair price, the entire weight of the decision shifts from the price itself to the quality of the underlying asset. The central overriding question becomes, what precisely constitutes a wonderful business? Getting this judgment right is the prerequisite for the entire strategy. Paying a fair price for a business that you think is wonderful but is actually just fair is the fast track to mediocre returns. Paying a fair price for a business that is secretly terrible is a recipe for disaster. Therefore, mastering the art of qualitative due diligence, the process of identifying true, durable greatness, is the most critical skill a long-term investor can develop. Warren Buffett's approach to this is not based on complex algorithms or speculative forecasts about disruptive technologies. It is rooted in a set of timeless, common-sense principles for evaluating a business's competitive standing. The perfect illustration of this in action a story where Buffett demonstrated his almost supernatural ability to see business quality through the fog of market panic, is the tale of the Great Salad Oil Scandal. The year was 1963. American Express was not yet the global financial behemoth we know today. It was primarily known for its travelers' checks and a newer, burgeoning credit card business. It also had a division involved in warehousing, where it would certify the inventory held in storage facilities, allowing companies to use that inventory as collateral for loans. One of its biggest clients in this division was Allied Crude Vegetable Oil, a company run by a charismatic fraudster named Tino DeAngelis. DeAngelis had devised a brilliantly simple scam. His massive storage tanks in Bayonne, New Jersey, were supposed to be filled with valuable salad oil. In reality, most of the tanks were filled with water, with only a thin layer of oil floating on top. When inspectors came, they measured from the top. The scam unraveled. Allied defaulted on its loans, and the banks that had lent money against the non-existent oil came knocking on American Express's door, holding warehouse receipts that Amex had certified. The market panicked. Wall Street assumed the liabilities from the fraud would be so immense that they would bankrupt American Express. The headlines were terrifying. The stock, which had been trading around $60, plummeted to $35. It was a crisis of confidence, the ultimate test of a company's reputation. This is where Buffett, the business analyst, went to work. While everyone else was focused on the scandal, on the salacious details of the fraud and the potential legal liabilities, Buffett asked a different, more fundamental question. Has this event damaged the actual core businesses of American Express? He didn't rely on Wall Street reports. He engaged in what is now famously known as scuttlebutt. He went out and did his own primary research. He walked into banks and asked them if they were still planning to use and recommend American Express travelers' checks. They all said yes. The scandal had nothing to do with that side of the business. He talked to merchants and restaurant owners. Were they still accepting the American Express card? Were customers still using it? The answer, again, was a resounding yes. What Buffett discovered was that the true value of American Express was not on its balance sheet. It was the trust it had built over decades, with millions of customers and thousands of merchants. This trust, this brand, was an intangible asset of immense power. The salad oil scandal was a large but ultimately survivable financial wound to a peripheral division. It had not touched the heart of the enterprise. The market, in its panic, was confusing a temporary fixable problem with a permanent impairment of the core business. He concluded that the fundamental earning power of the real American Express was intact and growing. While the market was pricing it for bankruptcy, Buffett saw a wonderful business, temporarily stained but fundamentally unharmed, being offered at a ridiculously wonderful price. He famously invested 40% of his investment partnership's capital into Amex stock, an act of supreme confidence. The market eventually realized its mistake, the company survived and thrived, and Buffett made an absolute fortune. This story provides the perfect blueprint for the mental model required to identify greatness, the castle and moat analysis. Step 1 is to understand the castle. The castle is the business itself. What does it do? How does it make money? What are its products and services? Is it profitable? Is it growing? This is the basic financial analysis that any competent investor performs. But this is only the beginning. The 99% of investors stop here. Step 2, the crucial step, is to identify and analyze the moat. The moat is the durable competitive advantage that protects the castle from invaders. It's the structural feature that allows the business to earn high returns on capital year after year without having those profits competed away. Buffett thinks about moats in several categories. There are brand moats, like See's Candies or Coca-Cola, where the name alone commands pricing power and customer loyalty. There are network effect moats, like American Express, where every new user of the card makes the network more valuable for merchants, and every new merchant makes the network more valuable for users. There are switching cost moats, where it is too expensive or inconvenient for a customer to move to a competitor. Think of a company running all its systems on Microsoft Windows. And there are low-cost producer moats, like Geico in insurance, which can offer lower prices than competitors due to its structural cost advantages. A business without a deep and wide moat is not a wonderful business. It is a castle with no walls, vulnerable to constant attack. Step 3 is to evaluate the knights who run the castle. This means assessing the quality of management. Are they honest and transparent with shareholders? Do they have a track record of rational capital allocation? Do they think like owners of the business? Or do they act like hired hands, focused on their own salaries and perks? A great castle with a wide moat can still be ruined by a foolish or dishonest king. Buffett will only invest in businesses run by people he admires and trusts. The antithesis of this disciplined, moat-focused approach is what most of the market does. They chase narratives. They invest in hope stories. They buy into the latest hot trend, electric vehicles, artificial intelligence, genomics, without any rigorous analysis of the specific company's competitive advantage. They are buying the story of the industry, not the reality of the business. An industry can be revolutionary, but that doesn't mean every company in it will be a good investment. The early auto industry was a technological marvel, but hundreds of car companies went bankrupt. Owning the narrative of cars of the future was not enough. You had to own Ford or General Motors, the companies that built moats around their manufacturing scale and brands. This is why Buffett has historically preferred boring businesses. Insurance, railroads, utilities, soft drinks, candy. These businesses are understandable. Their moats are identifiable and have stood the test of time. He avoids things he cannot understand. Industries where the competitive landscape is shifting so rapidly that it's impossible to predict who will have a durable advantage in 10 years. The financial connection here is direct and powerful. The presence of a wide moat manifests on the income statement and balance sheet as a consistently high return on invested capital. A company without a moat will see its profitability constantly under pressure. If it earns high returns, competitors will flood the market, driving prices and profits down. Only a company protected by a moat can sustain high returns for decades. Therefore, when you analyze a company's financial history, a high and stable ROIC is the financial signature, the empirical proof that a qualitative moat truly exists. It is the number that validates the story, connecting the abstract concept of a competitive advantage to the cold, hard reality of superior financial performance and, ultimately, superior portfolio growth. Having developed the philosophical conviction to pay a fair price, and having honed the analytical skill to identify a truly wonderful business, the investor arrives at the final, practical challenge: execution. How does one determine what a fair price actually is? How do you translate all of this qualitative understanding into a concrete buy or no buy decision? This is where theory must become action, where the art of business analysis meets the science of valuation. It is a process fraught with the risk of false precision and the psychological trap of analysis paralysis. Many investors get lost here, building spreadsheets so complex they obscure the simple, underlying truths of the business. Buffett's method, by contrast, is a masterclass in focused simplicity. It's about being approximately right rather than precisely wrong. The quintessential example of this execution framework in practice is Berkshire Hathaway's monumental investment in Apple, which began in 2016. At the time, Apple was anything but an undiscovered gem or a beaten-down cigar butt. It was one of the largest and most profitable companies in the world, followed by every analyst on Wall Street. By many conventional metrics, it didn't scream cheap. The stock had had a huge run in the preceding years, and the dominant narrative was one of concern over peak iPhone. The fear was that Apple's growth would stall as the smartphone market matured. The typical bargain-hunting value investor wouldn't have touched it. It wasn't trading at a discount to its book value. It wasn't a statistically obvious bargain. But Buffett and his team, particularly his investment deputies Todd Combs and Ted Weschler, looked at Apple not as a hardware company subject to vicious product cycles, but as a consumer products company with a vast and sticky ecosystem. They saw the iPhone not just as a phone, but as the indispensable remote control for modern life. They understood the immense switching cost moat. Once a person is embedded in the Apple ecosystem, with their photos in iCloud, their music in Apple Music, their apps from the App Store, the friction and cost of leaving for an Android device are enormous. They analyzed the incredible brand loyalty, a moat as powerful as Coca-Cola's. They saw the burgeoning high-margin services business as a second engine of growth that was being undervalued by the market. They did the work and concluded that Apple was a truly wonderful business. The next step was valuation. Instead of trying to predict next quarter's iPhone sales, they applied a mental model we can call the 10-year bridge. This is a practical, simplified version of a discounted cash flow analysis that avoids false precision. Step 1 of the 10-year bridge is to look across the bridge to a decade in the future and ask, is it highly likely that this business will be earning significantly more money in 10 years than it is today? This is the ultimate test of a durable competitive advantage. For a company in a rapidly changing industry or with a weak moat, the honest answer is, I don't know. That's a pass. For Apple, Buffett's team clearly believed the answer was a resounding yes. The ecosystem was strong and growing. Step 2 is to estimate a conservative range for the company's earnings per share in 10 years. This isn't about a single number, it's about a probable range. You don't need to be precise, you need to be reasonable. You look at the company's past growth, its market opportunities, and its reinvestment potential, and you make an educated guess. Let's say, for argument's sake, they projected a range of future earnings. Step 3 is to apply a reasonable and conservative multiple to those future earnings. What will the market likely be willing to pay for this business in 10 years once that earnings power is proven? A multiple of 15 is a good starting point, as it's close to the long-term historical average for the stock market. A great business might command a higher multiple, a more cyclical one might command a lower one. Multiplying the projected 10-year earnings by this conservative multiple gives you a potential stock price in 10 years. Step 4 is the final and most critical step. You must discount that future price back to today to see what it's worth to you now. If you want to earn, say, a 10% annual return on your investment, you calculate what price you would need to pay today for it to grow to that future value at a 10% rate. This resulting figure is your estimate of the business's intrinsic value today. If the current stock price is comfortably below that calculated intrinsic value, you have a, quote, margin of safety. This margin of safety is the cornerstone of the entire Buffett philosophy. It's the cushion that protects you from being wrong. The team at Berkshire looked at Apple's price in 2016, which was trading at a P/E ratio of around 10 to 12. They ran this exact kind of analysis and concluded that the market price was significantly below their conservative estimate of its intrinsic value, so they started buying. And they kept buying, eventually making it Berkshire's largest single investment. They weren't trying to time the bottom to the penny. They were confident they were buying a wonderful business at a fair price, with a substantial margin of safety. The path of the 99%, the antithesis of this thoughtful, business-focused valuation, is the path of the technical trader. This individual ignores the business entirely. Their world is the stock chart. They are obsessed with squiggly lines, moving averages, relative strength indicators, and other esoteric patterns. Their buy and sell decisions are triggered by price movements, not by calculations of value. They believe the history of a stock's price contains all the information needed to predict its future. This is the ultimate intellectual abdication, a complete separation of the stock from the underlying business it represents. It is a world of noise, emotion, and high transaction costs, a game that is virtually impossible to win over the long term. The direct financial connection in this execution framework revolves around Buffett's preferred metric, owner earnings. To get a true picture of a business's value, Buffett ignores the often misleading GAAP net income figure reported in financial statements. GAAP accounting includes non-cash charges like depreciation, which can understate a company's true cash-generating power. Instead, Buffett calculates owner earnings. The basic formula is net income plus non-cash charges like depreciation and amortization minus the average annual amount of capital expenditures required to maintain the business's competitive position. This figure is his estimate of the cash that is truly available to the owners of the business each year to either be paid out as a dividend or reinvested for growth. It is the real-world cash flow. By basing the 10-year bridge valuation on a projection of future owner earnings, not reported net income, an investor gets a much more realistic and conservative picture of a company's intrinsic value. This is not a technique used by the average retail investor. It is the methodology of a professional capital allocator, a CEO, or a private equity firm considering the acquisition of an entire company. Adopting this framework is how an individual investor elevates their game from amateur speculation to professional-grade business analysis. It is the final practical tool needed to confidently identify and act upon the promise that a wonderful business, even at a fair price, is the surest path to building lasting, generational wealth. You have just spent your time and attention, the most valuable assets you own, to acquire a powerful new piece of mental hardware. You now possess the master key that unlocked billions of dollars in wealth for Warren Buffett and the shareholders of Berkshire Hathaway. It is the profound and liberating shift from the frantic search for bargains to the patient acquisition of greatness. You understand that the frantic obsession with finding a perfect price is a psychological trap, a prison of our own making built from cognitive biases like anchoring and loss aversion. You have seen the mathematical proof that over the long term, the internal compounding engine of a truly wonderful business will always outrun a cheap starting price on a mediocre one. You have been given the blueprint for identifying these wonderful businesses, the castle and moat analysis, and the execution framework to determine a fair price, the 10-year bridge. This is not just a stock tip. It is a complete, top-to-bottom system for thinking about investing as what it truly is, the act of becoming a part owner in an exceptional enterprise. But understanding this principle, as powerful as it is, represents only one hemisphere of the complete globe of investment wisdom. Knowing what to do is half the battle. Knowing what not to do is the other, equally critical half. Buffett's unparalleled success is a story written in two inks. The bright ink tells of the brilliant investments he made, the See's candies, the Coca-Colas, the apples. But the invisible ink tells a story of the catastrophic mistakes he masterfully avoided. He sidestepped the dot-com bust that vaporized trillions. He avoided the complex derivatives that brought the financial system to its knees in 2008. The very principle we have just explored, the discipline of paying a fair price for undeniable quality, is the greatest defense against the market's most seductive and dangerous traps, the value traps. The fair businesses that masquerade as wonderful bargains, the cigar butts that have no puff left in them. The old Buffett, the pre-Munger Buffett, would have fallen for some of them. The evolved Buffett knows how to spot them a mile away. The video that is now appearing on your screen is the other half of this map. It is not just another piece of content. It is the vital, indispensable link that connects the principle of buying quality with the ironclad discipline of avoiding ruin. It is a deep dive into the mental models required to identify and ruthlessly discard the investments that look cheap on the surface but are, in reality, value-destroying traps. It illuminates the subtle differences between a company that is temporarily cheap for a stupid reason and one that is permanently cheap for a very good reason. This journey of intellectual ascent is not for spectators. It is for the architects of their own financial destiny. The casual learner stops here, satisfied with one powerful idea, holding one half of a blueprint. But the serious investor, the future capital allocator, the person committed to true financial freedom, understands that a partial blueprint leads to a flawed and unstable structure. The choice you face right now is a defining one. It is a reflection of your own commitment to this craft. Do you settle for partial knowledge, or do you continue the climb toward mastery? The next piece of the puzzle is waiting. Complete your mental arsenal, click, and continue the ascent.